It's time now for today's strategy session. We're seeing the S&P 500 and the NASDAQ open higher, rebounding from the Powell-led sell-off, but we are seeing United Health earnings weigh on the Dow. And year to date, it's been a tough one for stocks. All three major averages are in the red. So how do you manage your investments amid the volatility and uncertainty? Joining us now, we've got Carol Schleif, who is the Chief Market Strategist at BMO Private Wealth. Good to see you, Carol. So just take us into your own evaluation, especially we're early innings earnings season. We've got the Fed talking about the potential risks that tariffs bring to the economy and acknowledging what that means in their own broader kind of policy pathway here. How is this all translating into investment strategy?
Well, I think the important thing is coming into this set of volatility is we've been diversified in portfolios for a very long period of time. And it was interesting because even when you looked at the through March 31st performance, those globally diversified portfolios, a lot of international bourses were doing better than the U.S. markets were because of a lot of the volatility that we've talked about and the uncertainty that's been introduced basically since January 20th as markets and investors in the U.S. and around the globe have dealt with the policy changes and the tariff on again, off again, and what's going on there. But as you talked about, in the short run, there's a lot of potential volatility. We are more positive, if you will, about the back half of the year, and hopefully we get some narrative change in where the focus is of investors. But that means that diversified portfolios are really important to have because not only did those international bourses perform very well, but fixed income overall has provided the ballast in the intermediate term that you need it to provide, aside from the fact that the last week or two have been exceedingly volatile, even in fixed income.
And given, Carol, that you talk about gains to come in the second half of this year, that makes me think that you anticipate tech having some gains since they're so heavily weighted on the major averages here. Where are you seeing areas of opportunity within the tech sector for investors?
Well, we think it's not necessarily just tech, but we think it's broader out there in terms of a lot of that spending is not going away. We do think you'll get the narrative shifted because keep in mind, our President Trump 2.0 is the mirror image for markets of what Trump 1.0 was, in that in the initial, in the first Trump administration, we had tax cuts first and then tariffs. And here we've got the tariffs and the policy changes first that have impacted or are drawn into question sustainability of growth and durability. And even on the fringes, people are questioning the investability, if you will, of U.S. markets. But we think the narrative starts to shift later in the year towards tax, things that are pro-growth from a tax standpoint, if they can get some of the accelerated business deductions put back in, and the focus on rebuilding here in the United States. And you really see some action there where shovels are in the ground, plants are starting to go up. So it's not just technology, but it's broader industry in general as well. But we also think especially the software components of technology should continue to play, because as companies deal with increased tariffs, they've got to figure out ways to put margin, things that can potentially support margins in, and the continued deployment of technology is really important from that perspective as well.
Carol, with that in mind, I question what it means and what you're seeing when you are looking at some of the businesses that are just trying to operate through this uncertainty and pulling back on some of the big deals that they were planning on making, or perhaps even big purchases into things like software. Perhaps they don't think they need more licenses or more seats or to add on. So that creates a major headwind for some of the software companies that have already talked about elongated deal cycles even coming into this year and more deal scrutiny. So within the software thesis, who is best positioned despite some of those headwinds that we had already seen start to rear their head?
Well, the interesting thing is it'll vary by size of companies. Some of the big companies that are doing better here, if you will have the opportunity to be able to redeploy, especially if attrition takes headcount down and they're looking for opportunities. You've also got AI deployment, which we've seen from some of the initial statistics that small and medium-sized businesses, which may or may not be publicly held, but smaller, medium-sized businesses can really benefit from the AI deployment that's going out there. Now, we're prevented from compliance from talking individual securities, but there are, as you alluded to, a lot of moving parts here in figuring out how companies are going to respond. The interesting thing is for those companies that have debt with banks and lenders and public shareholders, they can't sit forever on the sidelines. They have growth objectives that they have to adhere to, and so they've got to figure out how do they tweak things through, how do they work it through the economy. And it's exceedingly challenging time to be a business owner, but we think the durability and the flexibility that they've shown over the last 8 to 10 years with all the challenges they've been faced with will serve them well in this environment as well.
Carol, thanks so much for making the time. Appreciate it.
Thank you.